The end of the week was also the end of a quarter and the end of a month, and trade tensions drove markets, especially this month. But they particularly drove markets down. Global equities in general, especially those exposed to trade tensions, have closed sharply lower, both for the quarter and especially for the month. China was particularly hit the harshest, with the Shanghai Stock Exchange and the Hang Seng, both closing decisively lower, especially on the month. We It's becoming clear because many people would have probably expected that the trade tensions or the tariffs threats were a way to maybe like a bargaining chip to obtain something, maybe to obtain concessions. But it's becoming clear because we have the first deadline coming up, July 6th, where 34 billion worth of tariffs will be imposed on China. They're going to effect. So that's starting to sink in for many market participants. So after July 6th, I think a few days after, there's going to be another 16 billion tariffs that will go into effect. So that are becoming clear. That's becoming clear. So the fact is, tariffs are also having an effect in the economy. Many economies, we've seen the Chinese factory data this week coming out pretty negative. That means that the tariffs will start having an effect, And we've seen complaints from U.S. farmers and cattle raisers and so forth that are also complaining about those tariffs. Now, we in the beginning of this week, we had the administration, the U.S. administration, backed by Congress, that decided to restrict Chinese investment into tech firms. So we've seen that tensions are taking different shapes now, and reminding people that this is becoming real. So there's restriction on investment where many people still believe Chinese money is welcome, but those restriction really weights on many investors for the time being. In the beginning of the week, we had the Reserve Bank of New Zealand, which came out and left its monetary policy unchanged, and they cited trade tensions as one of the reasons, as probably the main reason why right now they have to remain on hold, because we don't know how they will pan out. We also had growth data, GDP, gross domestic product growth data from the U.S. economic growth, and it came in lower than expected at 2%. And one thing that we could have drawn from the data is that business are smaller investments because of the trade tensions. Trade tensions making certain businesses a little bit nervous, and they want to hold some investments, and temporarily halting purchases, and also that the consumer spending also was lower than expected, and we're seeing a rising interest rate may be having an effect on consumer spending. We've seen that in housing data, that the past three housing data really so the housing market is slowing, and that reflects the consumer aspect of things. And finally, we had on Friday, Canada will also impose 12 billion worth of tariffs on American goods. So these tensions, the trade tensions and the tariffs are becoming a reality. And the Fed chair acknowledged it in the last week speech. And we've seen monthly candles for European equities, especially those mostly exposed to trade, falling sharply, the German DAX and especially the Chinese equities. So we'll see how the next quarter will come in, but it's set to be more positive for the U.S. economy.